What is going on, everyone? Anthony Drew Gary here, host of the How To Show. And this week I am covering something as the result of one of the shorts that I put out a couple of days ago. So I covered a little while ago, basically a New York Times article that suggested that of the 2,100 and something mutual funds that are actively managed, none of them managed to beat the index. And I realized in putting that video together, a couple thousand people saw it, which is awesome. People are interested in the topic, really cool. That I need to go back to basics a little bit, and I think that it's only appropriate to do that in long form rather than short form because I don't think I can cover that in 30 seconds. So, when you compare mutual funds, there are a handful of things that you're going to be looking at. And so for the most part, you have to know what the names of the funds are. And so if you're interested in that, you can basically run Google searches for different funds. And I've pulled three for the benefits of this video today. And if you compare them all on the same type of website, you usually have the same type of apples to apples numbers that you can compare things again. And so we're going to use Morningstar's website. We're only going to use the free features of it now. You can see some of the analyst rating and things like that. Will it outperform in the future? Things like that. All that's locked, and they're trying to get you to pay for their speculative services of what they think is going to happen. But that's not what we're doing here today. We're just looking at the basic metrics of a mutual fund and how to compare them ultimately. And so the first one we're going to start out with is SWPPX, and we're doing that because it's an S&P 500 index fund. And this one's offered by Schwab. There are equals that are offered by Fidelity, by Vanguard, by several other companies as well. And essentially, this type of fund is the exact same thing no matter where you buy it. It is an index fund that tracks the S&P 500. And so when you buy a share of this fund, you are buying a share of the 500 companies that make up the S&P 500. And so when you start to look at the different options on the Morningstar website, the first thing you see is a quote. And so it's showing up 61.24. That's what this mutual fund traded for most recently. And then it talks about current assets. Basically, if you took all of the folks who own this fund and you add it all together, that's what you get. And then you get to the adjusted expense ratio. Want to spend some time here because you'll notice this is going to vary from fund to fund as we look at these. And so the expense ratio for this fund is 0.02%. And so essentially what that means is for every $100 you have invested, the cost of operating the fund is going to charge you 0.02% each year. And so 0.02% on $100, I believe is 2 cents if my math is right there. And so this is a really inexpensive fund to manage because not a lot has to happen to manage it. It is essentially buying the 500 companies in the S&P, and at any given point in the year, you can do that and you know what you're going to get. And so we continue here. We're going to look at another item here that I think is of importance. And this is share class type, and this is no load, and the alternative to that is load. And so we'll talk about that in a little bit when we pull up a mutual fund that does have a load. But basically, there's no upfront cost to purchase this fund. You pay the market price for it, and you get it. And so this is a category. It calls itself large blend, generally because these are large companies that make up the S&P 500. And the other thing that I want to look over here is turnover, and this is calling out turnover at 2%, and that's basically the amount of fluctuation of the companies inside the fund. How often do they change? I believe it's on an annual basis, and they're suggesting that it's 2%. And so of every 500 of the companies that are in this fund, 2% of them are going to change each year. And so I think that's a relatively low number, especially when we start to look at some of the other options. And so there are other tabs here. You can go to the chart and it'll show you what this fund does over time, and you can pinpoint it and you can look at it over different points in the year. But the other thing that we're going to look at here is we're going to click into portfolio. And if you don't know what the S&P 500 is, you can start to do your homework and find that out. You know, this is 98% in the United States, which is valid because the S&P 500 is a metric of United States companies. And you can start to look at different, dividend yields. You can start to look at the sales growth, the historical earnings. But what I found most interesting about this is that you can scroll all the way down and it'll show you the key holdings of the fund. And so the key holdings of this one: Apple, Microsoft, Amazon, Alphabet, which is Google, Berkshire Hathaway, which is Warren Buffett's brainchild. And so what you find here is that there's also a weight. And so for every one share of this fund, 6.46% of it is actually going toward buying Apple. And so you don't have to actually make 500 different trades to get the S&P 500. You're getting it by way of investing in one fund. And you can go out and do specific searches, using the fund name, blah 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 blah, the 5 letters or 4 letters, however many it is, and you search for total holdings or asset holdings or number of companies, and you can get the list. The prospectus, as it's called, is created by each fund manager, and you can read it in greater detail. But I'm using Morningstar's website just to be able to compare 3 of them quickly, apples to apples. And so that's the type of thing that you see with an S&P 500 index fund, which is essentially the index that I talked about in the short a couple of days ago, where the money market or the money managers or the actively managed funds aren't beating the market over long-term periods of time. And so we'll switch over now and we'll go over to AIVSX. And this is the Investment Company of America through American Funds. And this is another very popular fund by naming right, because it's been around for a really long time. And you'll see that there's some metrics here that are a little different than what we saw a minute ago. And so the expense ratio here is 0.57%, as compared to 0.02% a minute ago. And so in the last example, if you had $100 in, you would lose 2 cents every year. And so this example, if you've got $100 in, you would lose 57 cents. And so you gotta pay attention to those. It doesn't sound like it's a big deal right now, but we're only talking per $100, and we're only talking for 1 year. If you start to compound it out, it can make a difference. And then you go over here and you look at share class type, and this is front end loaded. And so what this means is that in order to buy into this fund at all, you have to pay basically a sales commission to get into this. And so if you spend $100 getting into the Investment Company of America, you may only get $94 or $95 worth of the fund, because you're paying basically a sales commission on it. And so you continue to look at this. It has a minimum investment option. Not all of them do, but some of them do, and they vary in size. Again, this is a large blend, but this one over here, you see the turnover here, and this one is at 22%, which means that somebody making the decisions for this mutual fund is pulling in and out stocks into the mutual fund or out of the mutual fund at a rate of roughly 22% of the entire fund's balance each year. And so when we go to portfolio, this starts to get a little interesting. So you wonder, what's going on in here if they're pushing and pulling 22% each year. And you scroll all the way down and you find the key holdings for this firm. This one's Microsoft, Amazon, Broadcom, Philip Morris, United Health. And generally speaking, these are a lot of the same companies that you're finding in that other fund, because they are the large cap companies of the United States of America. And realistically, the 22% turnover is probably in the smaller companies that make up a lesser amount of the fund. But you can look at this and you can do your homework on this before you decide to pick any one fund. So let's take this one step further, and we're going to look at FSELX, which is Fidelity's Select Fund for Semiconductors. And this is a very niche type of mutual fund. And so this is a much smaller fund. This one's in the neighborhood of $6 billion in total assets, trading at a lower price. And then you start to look at this. The expense ratio here is 0.68%. And so again, for $100 for the whole year, you pay 68 cents on it. This one doesn't have a load, and you continue to look. This one's category is technology. It's going to be very specific in what's in it. But the turnover here is 33%. And I suspect that a good reason for that is because companies get acquired, companies go out of business, new companies come out, and we have to have them. And so we throw them into the fund and we switch them in and out. But we can continue to look at the portfolio and find out what's in this fund. And so this fund is really heavy into NVIDIA, and it's got some other companies here that you've probably heard of. Some overlap between this fund and the 2 previous funds that we've looked at, but ultimately you want to make sure that you know what you're investing in, and this is a good way to do it. You can look at different things apples to apples by looking at one of these basically aggregators such as Morningstar. There are other ones that do the same thing. I know Yahoo Finance is really good at it, and you can look at different funds such that you can be better informed to decide what makes sense for you when it comes to buying some of these things. And the next step to that is you need to decide what you're buying them in. Are you buying them in a taxable brokerage account? Are you buying them in a retirement account? And if you are, what kind? Is it an IRA? Is it a Roth IRA? These are all the sorts of questions that you need to be asking yourself and doing your homework on if you are doing it by yourself, I guess, or having intelligent questions to ask if you are having somebody help you with this, who you are generally paying some sort of a fee to do that. So you want to understand the basics behind it just so that you can ask intelligent questions. And so when I talk about 2,100 and some odd change actively managed funds not being able to beat the index, the reason that you might find that out is because, you go back to the quotes, and the expense ratios for the index funds are very low. And the expense ratios for some of the active managed funds are a little bit higher. And so maybe there's some sort of reason behind this that, the turnover is higher here than it is here because these folks have to make justifications for their own expenses, that they're doing more work on the fund. They're making the fund better by weeding out the bad, only keeping the good. But you have to do the research for yourself to figure out whether or not the results reflect that, or you could read the New York Times article that tells you that they don't. That's going to bring this episode of the show to a close. If you have any questions about this, any thoughts, any comments, leave me a note down below. I will respond to each and every one of them. And if I don't have the answer, I can help put you in touch with somebody who does. If you've got any ideas for future topics on the show, I am all ears for those as well. And as always, if you are looking to transact real estate in the Indianapolis market, I can help you with that. Get in touch with me in the comments or at indiedwell.com. You can be a subscriber to the show, be the first to know about new long-form content each and every Wednesday, or short-term content in the shorts pretty much every day now because it's a lot of fun doing those, and it's helping a lot of people. Till next time, this is Anthony Drew Gary, host of The How To Show, signing off.